What's up, everybody? It's Professor Rako, continuing on with our chapter on accounting for income taxes. So, our last video, we did some brief examples for a deferred tax asset and a deferred tax liability. So, I'm kind of picking up where I left off there. So, if you haven't watched the previous one, the numbers I'm going to pull from here come from that prior video with the deferred tax asset portion, which is the second half of that video. So, you may want to just refresh your memory, go back, watch that real quick. It's won't take you very long, and then come back to this. But if not, you should be able to pick it up pretty quick. All right, so when you have a deferred tax asset, you have to evaluate whether or not you need a valuation allowance, okay? Meaning, so think about what a deferred tax asset is. It's something you expect to benefit from in the future. You expect to benefit in the fact that you're going to pay lower taxes in the future because of a deferred tax asset. All right, so if you expect not to realize all that deferred tax asset, you need to reduce it, and we reduce it using a valuation allowance. It's the same thing conceptually as reducing accounts receivable with allowance for doubtful accounts, meaning what you expect to recover on accounts receivable. Same thing here, what you expect to realize on a deferred tax asset. All right, so if you look up here, the wording's a little vague. All right, so if it is more likely than not, which they say 50%, that it will not realize part or all the deferred tax asset. All right, so you can go back and look if you get into it. I mean, there is research that shows that, when you have anything vague like this, you got to be careful that management might use it to kind of, move numbers one way or the other if possible. By using a valuation allowance, and you'll see when we get down here to the actual journal entries. All right, so the valuation allowance, like I was saying, is a contra asset account, just like the allowance for doubtful accounts. So it reduces the deferred tax asset to the expected realizable value. All right, so remember, anytime you have a contra asset, you have asset less contra asset equals the number on the balance sheet. All right, so accounts receivable is net. Think of historical cost of a fixed asset less accumulated depreciation, which is the contra asset, gives you the book value on the balance sheet and so forth. Meaning we don't reduce the asset itself. We use a contra account to reduce it down to the number that we're going to show on the balance sheet, meaning the asset still stays in place at the actual number. All right, so using the example from the previous video, okay, it says suppose they only expect to realize $3,000 of the deferred tax asset. Okay, so this right here was the entry, so I just went ahead and typed that back out. That's what we wrote out in the last video. That was the journal entry to record taxes for that warranty example we used prior, right? They had a difference of, I believe it was 10,000. 10,000 times the 4% gives me the 4,000 deferred tax asset. All right, so the 4,000 is on the books. Now it says if we expect that we're only going to realize 3,000, how do we adjust to reflect that? Okay, so to do that, we're going to make this journal entry. All right, so I'm going to debit income tax expense for 1,000. And then this credit's a little bit long. Okay, it's the allowance to reduce, and different books call it different things. The deferred tax asset to the expected realizable value. I think that's something similar to what your book probably calls it. So something like that. All right, and that's for 1,000. Okay, so this is the contra account. All right, so now notice we still have the 4,000 on the books, but now we have this 1,000 contra asset that we're going to reduce the net deferred tax asset down to 3,000. All right, the reason we debit up here income tax expense is, remember, up here, this 4,000, it reduces this 20,000. Okay, so we pay. Remember, our payable is 24. But we had a deferred tax asset of 4, so we recorded income tax expense of 20. However, if we reduce this number right here to 3,000, this number would have been 21,000 if it would have been 3,000 originally. All right, so that's why it makes sense to increase with a debit to the income tax expense of 1,000. All right, so here's where managers can manipulate it. So obviously, income tax expense will affect net income. All right, it's reevaluated at the end of each accounting period for any adjustments. All right, so if we later expect, let's say now we change our mind, or our assumptions change, or our situation changes, and we expect to realize 3,500 instead of 3,000. Well, we've already created this allowance right here for 1,000, which it says, so that means we expect to realize 3,000. However, now we're saying, oh well, let's assume we're going to realize 3,500. Well, if that's the case, we need to reduce the allowance. Now remember, the allowance, I'm just going to abbreviate. So allowance to reduce the DTA to expected realizable value. So we need to reduce that. So remember, it's a contra asset, so it's a normal credit account. So this debit reduces it, and the offset is to reduce income tax expense for that period. All right, so if we reduce income tax expense, all right, so that's reducing expense, so net income will go up. So we can see up here, this $1,000 will make net income go down. This 500 will make net income go up. All right, so you can see, I mean, when you start dealing with bigger numbers, if a management is up against the wall as far as meeting their earnings benchmark for the period or their analyst forecast benchmark, whatever the consensus is, they can use that. And there is prior research that shows, companies do possibly use that to manipulate. Obviously, auditors are aware of that, but it's always something to be aware of when you go forward in your professional career, to kind of look at things like anytime there's an allowance and there's a lot of judgment used on management, you have to go through as an auditor and make sure those assumptions and judgments they're using are valid. All right. So this is an example of a valuation allowance. It's only used with a deferred tax asset. All right. I typically tell my students I'm going to probably test them more on this in a multiple choice question, meaning if I have a bigger problem that I'm working out on the exam or having them work out in the exam, I usually don't throw this in there. So always pay attention to how your teacher approaches things. I typically will tell my students, this might be more of a multiple choice question. If your teacher does that, great. If not, really pay attention to how much emphasis they put onto it. All right. But the main thing is, you're looking for this, the wording up here. They expect to realize 3,000, but you knew the number was 4. Therefore, it's a deferred. Therefore, you're going to need that valuation allowance. And once again, that will only be with deferred tax assets. All right. So hopefully it helps you grasp the valuation allowance a little bit more. When we get rolling here next video, we're going to start doing some longer examples. Start focusing on our reconciliation from financial income to taxable income, which is an important key step in this chapter. All right, so make sure you tune in next time, and we'll get into a little bit more detail. All right, see you next time. Thanks.